Joining us now, Adam Farstrup. He's head of multi-asset for the Americas at Schroders, which has more than $1 trillion in assets under management. So, all right, we have this set up here. People have been celebrating a very good earnings season. I was saying we had a little bit of a scare that the Fed was going to have to start to push back. Now that's getting priced out. What is a multi-asset investor supposed to be doing? What are we rethinking right now in this context?
You know, it's really interesting because as a multi-asset investor, you've got the whole world as your oyster.
Yeah.
And we have been very long equities for the past 3 years. And every month when we come back to these conversations and say, where are we now? We look at that and we still see that equities drive. And you sort of feel as a multi-asset investor, maybe I should be doing something different. What is interesting is the opportunity within equities. So to really broaden out, we think you want to stay long U.S. exceptionalism, long U.S. technology, but think about how you can complement that because that risk within the trade of that one AI trade is very significant from here.
This notion of broadening out, I mean, I feel like everybody hopes for it, maybe plays for it. It's happened in these sort of phases, like these interludes, right? So late last October, we had this massive peak in the narrowness of the market. Then we broaden out. The S&P does nothing for several months. Underneath the surface, most stocks go up. We also saw the same thing just coming out of this latest period. Can that be more of a sustainable trend? I've looked at history and it says, look, you're not making progress in the headline index if you really see the majority of stocks outperform.
Yeah, absolutely. It's not unusual to see concentration within equity indexes. What is unusual is the degree to which we've seen that and the single risk factor from that AI trade. So I think you should expect this to come in waves, but that is where diversification works. So if you had been diversified across that supply chain, you weren't as sensitive to the semiconductor meltdown. You look at value outside the U.S., cyclicals, bank stocks in Europe. I mean, we had a period where the bank stocks in Europe have been outperforming the Mag 7.
Right.
So it is working if you stay disciplined.
How easy is it, though, to truly diversify away from the AI trade? I ask that because you mentioned bank stocks, for example. A big reason that they've been propelled to the upside is because they've been able to really draw a link to their role and their participation in AI, in financing the AI build out. You can see that across a variety of sectors as well. So does the diversification truly work if you're worried about some sort of reversal in the AI ecosystem or the AI economy?
I mean, I think it's true that you're going to see, if you had an AI meltdown, this is going to impact the entire market. So diversification alone is not going to help you. But where it works is you think that bank example, the banks that we've really seen a lot of opportunity in have been European banks. They are not as involved in the AI financing. I'm not saying they're not involved, but they're not as involved. They're really trading off the yield curve in Europe, the resurgence in some of the financing activity happening in Europe, which is a much more banked economy.
I know you don't have S&P 500 targets, but if you take an earnings estimate of 365 for the S&P this year, put on the valuation, you get to about 78.50. We're at 78.35. So you're optimistic on stocks, but your not target, your sort of default zone is about where we are. Do you want to look to raise that, Adam?
So I think to see stocks drive higher, which we think is going to happen, you're either going to see earnings continue to beat, and it is interesting because we've had earnings estimates rising this year. Normally you'd see them being cut by this point in the year. We continue to see analysts raising their earnings estimates. So earnings may continue to power equities ahead above expectations, or we may get an expansion in multiples. The other thing that can happen, of course, is you look at the tech rally that we've had coming back off the lows, right? It is that opportunity for different pockets of the market to take that leadership away from just the core names that have worked over the past 3 months.